Maria, are we able to start the meeting without
Okay, everyone, we're on TV now, so I think, can you guys hear me? Yeah, okay. Yeah. I think we're good to go.
Okay.
We are on the government channel on TV. We are on the BOE channel on YouTube. For some reason, there is a connection issue, but we will rectify that to make sure this meeting's available on the Gov channel as well.
Okay. Thanks, Melissa, for all your work. I'd like to call the regular scheduled meeting for the Retirement Plan Subcommittee to order. Before we start, I just want to thank everybody for taking all the time out for these meetings. I know the town residents appreciate it, and I know the participants of the retirement plans also appreciate it. We'll go on, excuse me, we'll go on to the second item, which is a review of the minutes. Are there any adjustments to the minutes for the June 9th meeting?
I found these results.
Any review or adjustments for the minutes for July 27th? All right. Hearing none, may I have a motion to approve the minutes?
I'll make the motion to approve the minutes. This is Tom Potter.
Thanks. Do I have a second?
Phil Schultz, I'll second.
Thank you. All in favor?
Aye.
Aye. Minutes are approved. The next item on the agenda is recommendations for the investment options for the 457 and 401 play plans.
Great. Melissa, should I share, or do you want to share this screen? Or should I just go through the presentation either way?
I can share it. Oops. Actually, you know what? Why don't I just make you a co-host, and if you want to share your screen, would that be easier so you can walk through it?
That works. Hold on one second. Oh, that's not the one. Hold on. Bear with me here. Perfect. Can everyone see the screen? I assume everyone can. I will be brief. We discussed this during the retirement committee, but I'll be happy to answer any questions. We put a recommendation together for the transition to ICMA from MassMutual. If you look on page 102 of the deck, and I'm showing here, this is the current investment menu for the 457 and the 401A plan. It's a combination of obviously actively managed funds, the target date funds, and we were limited from the share class and from the opportunity set with respect to the types of funds we could offer. Evaluating what we could, and then thinking about lowering share classes as low as we possibly can. Utilizing the open architecture platform that ICMA provides to select the appropriate investment options. And then with respect to disruption, we wanted to minimize overall participant disruption, given the fact that we are moving from a record keeper MassMutual to ICMA. What we came up with was the page 103. So what we've done, obviously, we've replaced the general account, which we wouldn't have access to through ICMA, moving from MassMutual. We've now got access to Fidelity index funds at a very low cost compared to the Dreyfus funds that were previous. We eliminated the Templeton Global Bond, given that there's low utilization, as well as we haven't, when we benchmark the types of plans and what types of funds plans are offering, global bonds just hasn't been something that's prevalent in investment menus. And given its performance and its uniqueness, we decided to remove the global bond fund. We got access to the T. Rowe Price retirement iShare funds in its every 5 year as opposed to every 10, which was the previous. So now we'll have the 2020, 2025, 2030. So every 5 year we'll have the target date funds. And then given that we have Alliance Bernstein on watch for performance concerns, we've replaced that with Vanguard Explorer Value, a fund that we wouldn't have access to in the previous platform. And then, of course, you see within the index platform, we have the Fidelity Index funds over the Dreyfus, which again move the difference between the costs with the 500, the S&P 500 index. I believe is 20 basis points for the Dreyfus fund, and it actually is 1.5 basis points for the Fidelity 500 index. And then finally,
Tyler, it's Kevin. Is it possible to have an index fund in each category?
Absolutely, we could. We're concerned with the confusion that can add with respect to duplication. I think with the S&P 500, you're getting access to that both value and growth. Over time, we can introduce newer index funds across sort of large growth and small mid growth, but we want to overall keep things simple for employees. And then I guess what we can do is add those funds as we see them appropriate.
Yeah, I mean, I think if it was part of the education that's supposed to be taking place with all the individual participants, having an indexed option available in each of the categories, to me, makes sense.
So we're trying to build that out. So the idea is if I wanted to completely index, I have the access to sort of a core bond index. I have access to both a large cap and small mid cap index funds, as well as the international. So now I could completely asset allocate utilizing the Fidelity Index investment options. We could get a little bit more granular with respect to adding index and value, index and growth. Again, we're concerned with overcomplicating the employees with those additions. We can definitely look at that over time.
Yeah, I just think having a couple options within each category shouldn't complicate it too much, as long as it's not 15 per category. I think 2 or 3 should be adequate.
Should we look to add those over time, or?
I mean, I wouldn't mind having them to start with, but that would be my recommendation to, so for in the small cap, there could be a small cap index in there as well. Again, you pointed out correctly that Alliance Bernstein is on watch. So rather than go through the watch process, why not have an index in there as well to give people the option?
Alongside an active managed fund?
Correct. Yep.
Again, not typically what we recommend, but we're happy to look at doing that. Again, we cite typically on average is 12 to 15 funds in total. We start building on that. It can tend to confuse folks, but we're happy to look at adding, index funds where you want.
Okay. Yeah, so I would add them into each individual category. So you have large cap blend with an index. You should have a large cap growth with an index, small cap with an index. So each category should have at least one index in there to allow the people to, if they so choose through the education, to be able to choose to index or not.
Okay. So we're not adding a core small cap growth and a mid cap growth. We have the SMID caps. And there really isn't a SMID replacement other than the extended market that sort of covers this entire category. We could add a small core, small cap growth, mid cap growth, small cap value, mid cap value alongside these.
So you're saying extended like a VTI, Vanguard Total Stock Market Index?
So you have the extended market index here, which would cover this whole box here. We don't have a complementary small mid growth index or a complementary small mid value index. Okay. So we would have to break out the mid cap index and the small cap index. So in essence, what we would be adding is an additional 6 funds across the different style boxes you're looking for. My concern with the 6 funds, the additional 6 funds, and we then would have sort of an overweight in the small and mid cap space, given that it's roughly 25% of the total market cap. It would look like we're overweighting the small and mid space. but we're happy to do what the town sees fit.
I mean, any comments from anybody else about it? Hearing none, no comments. I mean, I'd like to be able to see an index option as part of it. If the individual participants are going to go through the education and go through the risk analysis with ICMA, then it should be clearly communicated.
I agree with Kevin. I think there should be an index option as well.
This is Art. I like the index option because there's just something about buying the whole market that gives an investor a certain amount of confidence.
Just to clarify, we're offering the index through the core. You just want it additionally through the wings, so to speak, with the growth and value.
Correct.
I can do
I
that.
mean, to the point, right? You did it in the fixed income category, right? You did the fixed in a Fidelity U.S. bond index, but then you gave the option for a fund, right?
Right, and the hope is that we do that through this, where this covers both of those categories. But we're again happy to sub out those index funds. It's not typically what we see in the marketplace, but we're happy to do so.
Okay.
Kevin, can you just state for the minutes why you think this is important? I think it would be helpful to capture that.
Yeah, no, I mean, I think it's important because as Tyler pointed out, sometimes the mutual funds aren't hitting their benchmarks, and then they go on watch. It could be for whatever reason. It could be for performance. Could be for the portfolio manager leaving. And by having an index option available, it rules out any of the risk that's associated with a portfolio manager or a fund not performing, because it'll perform it up against the index.
Thank you.
So for purposes of this meeting, again, we'll need to get this approved for this to move forward for the January 1st. And given that we don't have the actual index funds reflective in this proposal, I guess what the proposal will be is this set of funds on page 103, alongside the lowest cost index funds we can provide in the large cap value, mid cap value, small cap value, as well as large cap growth, mid cap growth, and small cap growth.
That's correct.
Perfect. Okay, we can put that together, but I just wanted to reflect it for the vote today.
Yep.
And then what we did is include, of course, the performance. MFS value is on watch, but the watch is more qualitative, given the fact that Steve Warham, who's been leading that portfolio team, announced that he would be transitioning to more global equities, but no, obviously, performance concerns. It's more obviously qualitative. And then there's some Eaton Vance noise with respect to the performance, but again, that's more their philosophy with respect to the types of funds that they're investing, and the fact that they look at more high quality names, healthy balance sheets, and some of the funds that have done well in that space have been sort of low quality biotech speculative markets. That being said, we'll be adding indexes alongside that. So, and then of course the target date funds have performed very well, and our top decile performance relative to peers. I wanted to be sensitive to time. Is that enough for folks to make a vote with respect to the proposed menu for ICMA?
I'm comfortable calling a vote. Maria, or how would you like the wording of the motion?
Sorry, I was just having a hard time unmuting myself. Perhaps something to maybe proceed with the investment options, maybe as presented, but with the noted amendments or something to that effect.
So moved. So I guess I'm going to look for a recommendation or a motion from somebody else other than myself.
make the motion. It's Tom Potter.
So I guess to let the minutes reflect, the motion is to approve or recommend for approval to the Board of Finance the proposed investments with the addition of the index funds onto the individual categories. Do I hear a second?
I'll second.
All in favor? Aye.
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 Okay.
Great. And actually, given that the defined contribution plan will be transitioning, I don't have any recommendations for the current lineup other than what I had today. And I also included the investment policy statement, which we don't have any recommendations to change as well. So that would cover my section. I'm happy to pass it on to Chris.
The only thing I wanted to add was a question really to Amy. I had raised a question about making it mandatory for enrollment, and I think there was a note that they had to go to HR to see if it was mandatory for new participants to automatically be enrolled. I'm not sure if we've heard anything or what we have to do in order to make sure that it's mandatory for new participants to be enrolled.
Yeah, so I'll let Maria answer that one. Her and Eric would be the ones to make that decision on how the process goes with incoming employees. So.
Yeah, so for the 457 plan, I'll have to go back and work with Eric just to double check all of our collective bargaining agreements, but I believe it's structured mostly the wording as it's voluntary. So if it's in the collective bargaining agreements is saying that it's a voluntary sort of participation, I don't know if we would be able to then essentially do mandatory enrollment at the time of hire. But that's definitely something, if it is, more structured within the collective bargaining agreements, it's definitely something we consider within the context of negotiations and, bringing up the concept of mandatory enrollment at the time of hire. Because, right, I mean, it's always easier to get folks to at least get enrolled at the time of hire than thinking about it, 6 months down the road, a year from now. So I think that's a really valid point, Kevin, and we'll definitely look into it to see if we can do that moving forward.
Okay, thank you.
Yeah.
Question, Kev?
Go ahead, Lisa.
Is there a way to do it as an opt-out? So it's voluntary, but you're automatically enrolled. But because it's voluntary, you have the right to opt out. And it's sort of accomplishes what Kevin is looking to accomplish within the means of the current contract. That may be possible. If worth consulting with counsel on that.
Okay, good suggestion.
Good point.
Can I just ask, because I'm in full support of that concept, especially as this is Chris, as Lisa mentioned it. Kevin, I think you proposed that on that was one of the questions you proposed on the July or June meeting, I forget. I like the concept. Is that something that that this committee has talked about previously? Is something that we would have liked to have instituted, or is that something that's newly come into the conversation? And is that this is just informational for me, but I am supportive of the concept. Is this something that the board, the committee as a whole, has talked about it and is in favor of it, or is it more something that's a singular and you're introducing into the conversation now?
Yeah, no, that's a good question, Chris. Tyler's brought it up on a number of occasions that the standard the new process going forward, most employers and plans are having people to automatically enrolled, and so they have to opt out for the plan. So it's been discussed several times over past couple of years. Would you say, Tyler?
Yeah, the movement in the industry is definitely going. Leveraging inertia for the betterment of the employee, leveraging the fact that people don't tend to do anything, so that the opt-out version is the better structure.
Thank you.
All right. We'll move on to Chris. So pension plan and OPEB trust performance reviews.
Great. Thanks, Kevin, and good morning, everyone. And I'm just looking here. I'm thinking, Melissa, right, some of the materials that ideally we'd have access to are in your big...
Here, let me pull it up for you. I can do that.
Yeah, I'm trying to see if I can, I don't know if folks can see it. I just have your package up, I think, that was appended to the meeting invite. Do people see that?
Oh, sorry, I just pulled it up too. What are folks seeing on the screen?
The agenda.
Okay.
Yeah, so is it scrolling for folks? Okay.
Yep.
Okay, so well, bear with me here. I think I've got all the pages marked. So a couple of things just to get started for folks. I think, as you all know, with the bulk of the group and the participants this morning on the meeting, we had highlighted, I think, briefly some of the second quarter performance. So I'm going to go quickly here, if that's okay for folks, in deference to the time constraints. And really on page 12 here, you see visually you can do that pretty effectively. I think, as everyone knows and has read and is well aware, the turn in market sentiment since the throes of the crisis, if you will, back in the mid-March, end of March timeframe has just been utterly remarkable. And the uptake, if you will, in investor sentiment and capital market outcomes has been pretty dramatic, as you know. And you see that here visually, and really the takeaway for the group, right, is twofold: is that investors have clearly gotten comfortable with the amount and magnitude of stimulus and the pledge to do more from central banks. And as you all know, there's a debate on a second fiscal stimulus package that's likely to re-elevate after the recess is done here. So there's expectations from investors that more is coming. More is coming in that fashion and form. And then clearly we're not healthcare experts, but the markets are pricing in an expectation that there'll be some form of a treatment or vaccine, it seems like, in the not too foreseeable future. And the takeaway, of course, has been dramatic, or the result has been dramatic. And again, these are numbers that we've talked about in our earlier calls, so I'm not going to linger on them. But big upswings in equities on a global scale in the second quarter. That's largely continued into the summer, as you know. We'll share some of those numbers for you. Until very recently, interest rates have been pretty well behaved, and fixed income returns have continued to grind along in a positive fashion. You see that in the upper left-hand corner of the page for the quarter. Kind of interesting under the hood there. Appetite for risk on display in the equity markets. You see a kind of under the hood in the fixed income arena as well. Take note there, for example, of the high yield markets up over 10% in the quarter. So, in kind of running for the hills at the end of March, and really the absolute opposite since then, almost unabated, just in terms of the way markets have reacted. And I think in the interest of time, I'm going to skip ahead of all this collateral. If you're inclined to look at it, or if you have questions, certainly take a peek at it, but it just shares some of the detail around those basic themes, that it's been a pretty productive and constructive time in the capital markets. And see momentarily the plans have enjoyed that comeback, if you will. Similar to Tyler, on the investment policy statement from a governance perspective with respect to the pension plans, just a quick visual there, just for the committee's edification. We're reaffirming, if you will, the construct of the policy statement, and think it's in good working order. The only recommendation we had, and we include a copy of it, and the only recommendation we have, you'll remember that this group, or large portions of this group, had approved the elimination of Van Eck not too long ago within the inflation bracket of the portfolio. You'll remember they were 1.5%, part of that 5% as it exists today. So the only recommendation, a minor one for the committee to contemplate this morning, was we need to reallocate that weighting right now that Van Eck is gone. If you statistically look at Van Eck's return streams and what it correlates most highly to, it would be domestic equities. So you see here just kind of simply and easily from our perspective, that 150 basis points moving from inflation protection in the allocation exhibit up into domestic equity. Otherwise, the IPS is in perfectly fine working order and doesn't need, in our estimation, again, any edits. So I'll defer to the chair here momentarily and see if this is something you're comfortable tackling this morning.
So you're looking for a motion to reallocate I'm not sure.
Or a recognition, Kevin, right? Just that we probably should change these weightings here, right? Because we don't have Van Eck anymore, and we do have the lower inflation bucket, if you will. So
I would say so recognized. I think it's still part of the Board of Finance responsibility to approve the reallocation.
Good point. Fair enough. Yep.
So what we would have to do is make sure that it's on the agenda for the Board of Finance meeting, along with the approval of the investment options. Thank you, Chris.
Okay, great. So from a
might have already done it at one of their other meetings when the retirement plan sub was invited. And then I think they'll have to vote on the policy. So I'll double check to see if they already did it. If not, we'll do both the policy and the change in the allocation for the next Board of Finance.
Okay, thank you, Amy.
Thanks, Amy. That's really it from a governance perspective. And again, so I'm going to go quickly here because I think you folks have seen some of these numbers already, but just to level set, it was a good quarter for the pension plans, 2Q on the heels of obviously a difficult Q1. So you see there in the middle of the page, the plans were up about 14% for the second quarter. So participated in the uptake or in the upswing. And a bit ahead of the benchmarks for the quarter, which is encouraging. As the market settled in there, the managers were kind of able to employ their disciplines and generate a little bit in the way of incremental return. And as we'll see momentarily, that has continued into the summer as well. So again, just stop me along the way here, but in the interest of time, knowing that you had seen and heard those numbers, and again, you see the individual plans and we roll them up into just what we call a 14% number. There's a little bit of differentiation plan to plan, but it's not material. So a good quarter for the plans. And I am going to bear with me here if no one objects. From a status perspective, the only thing in the pension plans of note to the committee, it's not a change in status. And I suspect it'll be the last quarter that the status exists, but you'll remember we did have the Templeton foreign small company strategy on watch. Performance has been reasonably solid, but you do see under the hood, as Tyler alluded to in his case in the DC program, there were some changes at the end of last year in terms of the folks that oversee the research effort. And our team has been monitoring that particularly carefully. By all accounts, things in terms of the transition have been going pretty well. So again, I suspect that strategy will come off watch here next time we convene. Otherwise, the roster for the pension plans are in good working order. I am going to, if no one objects here, skip through some of the gory statistical detail. Again, if there's a question, just please raise your hand or stop me. And then quickly transition over here, just so you have the data point for the OPEB. Same thing, right? We're all same thing in terms of absolute return, as you might suspect, but obviously we don't have a conversation here around active management still using the ETF construct with Liberty. So the performance for the quarter, right, generally over time is intended to match the blended benchmark. You see in this particular quarter, it did that precisely, up 13%. The variations here right over the long haul, as you can imagine, associate predominantly with the fee for the ETFs, which happens to be about 20 basis points on a weighted basis. So no surprise there when you look out over the long haul, that differential, but generally tethered to market outcomes as anticipated and desired. So all the ETFs are in good working order. No recommendations for the committee to contemplate this morning. And then I think of greater interest to this group, I suspect, bear with me here. I'm just making sure I'm not missing anything. This is all of Tyler's stuff that you just touched on. I'm just going to jump down quickly here to the very bottom of this exhibit, making sure I get to the right page. I did want to share July numbers with the group. for both pension and OPEB. And then we did have within the pension plan one thought regarding the structure of the fixed income and a potential change there that we just wanted to share with you quickly. So I know, Kevin, we've got a hard stop here, so bear with me. I think we're staying pretty well on time. Everyone done in short order here. Bear with me just a second. Is that freezing up? Here we go. I'm sorry. So the month of July, more of the same as you see here in the flash exhibit. So in the upper left-hand corner, equities for the month of July, the S&P up over 5.5% and uniformly positive results across the capitalization and style perspective. Elsewhere, markets continuing, I think, to function in a manner, right, that aligns with this idea that stimulus has been unprecedented and there's likely more to come. And again, kind of the nominal, maybe transitory, but nominal gains on the healthcare front and an expectation that there's a vaccine forthcoming. International markets were positive in the month as well of July. You see that in the upper right-hand corner of the page. Broad international markets up about 4.5%. In the lower left-hand corner, while interest rates have drifted a little bit higher more recently in the month of July, they were still reasonably well behaved in that kind of pattern we saw in the second quarter with a nominal positive returns and then higher returns, risk appetite. So more of the same on that front. From an allocation perspective, we're in, I think, reasonably good working order. No particular recommendation other than we're going to talk about fixed income momentarily. So I'm going to skip through the town plan, the Board of Ed. We'll come back to those momentarily with some more timely balances. But generally in good working order from an allocation perspective across the programs. And then you see for the month, another constructive month for the plans, up about 4 points in the month of July. So I think we're in reasonably good working order there. And then bear with me here. This is just the detail at the individual plan level. I wanted to share that same information for the OPEB and then finish with pension allocation and leave us. Here's OPEB here. So the OPEB allocations, I think, are in pretty good working order as well. There. Particular recommendation on the allocation front. And again, a good month, right? Up about 3.6% for the OPEB, about in line with the benchmark, again, as you would expect, given the style of investment in that program. So I think that is clearly hopefully the summary takeaway for the committee and something we've taken a bit of comfort in as markets have settled in here a little bit, right, from the chaos of the month of March. Some breadth of incremental return and a little bit of persistency as well in the case of the pension plan. So I think we're in reasonably good working order. Let me pause there for just a minute and see if folks have any questions. Again, I know that was quick, but I do want to be sensitive to time and again, recognizing that you had seen some, most of you or many of you had seen some of these numbers already. I didn't want to linger on them too long, but let me pause there for just a second. And if anyone has questions or comments or concerns missed.
I had a question, Chris.
Sure.
Is there any way you could show sort of a graphic? I appreciate, we get the Milliman summary at the end about where the start and end are. And maybe this isn't even for you, maybe it's for Amy or Maria, but to sort of get a visual like Vanguard or Fidelity does is what's the total volume of the funds? What are we making in terms of investment over time, so we could see it graphically and compare that to what's being taken out of the funds as an expenditure, so that we can see the full story. That may not be actually you. It may actually be ICMA or in-house.
Yeah, so I think, and we can work with Amy, Lisa, on that. And there is detail. If you get a chance in our report, there is a cash flow exhibit, a summary exhibit, where we work off of Wells Fargo, and it shows beginning and ending balances and net flows and investment gain loss.
Yes, but you don't see it over the 20-year time. It would be just nice to see a graph trend.
Visual. Okay.
Yeah.
So that's something we can work with Amy on, I think, put together pretty easily. The numbers are there, but if you'd like to see them visually, we can certainly take a crack at that, if that's okay. And then any other questions or from the group or things that resonate? No, people, again, it's obviously the numbers have been relatively solid, as you see, and the markets obviously have been accommodating as well. So that's been good. I would leave it right between now and the end of the calendar year. I think, as everyone suspects, the idea that volatility likely elevates a bit, given the election cycle and some geopolitical tension and the like, is probably not an untoward expectation. So something just to be mindful of. I don't think it demands a big allocation action, but just something we suspect you'll kind of hear and read about and encounter a little bit in the markets in the next couple of months.
Chris, could you speak to Warren Buffett's move in the Japanese markets and what's behind that, and what's the thinking, whether that changes your strategy at all or no?
So I have to confess, Lisa, I have not read all about what Mr. Buffett is doing over there. I would tell you more broadly, right, that he is probably, by reputation, the most contrarian investor of all time, right, who goes under the covers and looks for areas of dislocation and distress and discount. And so clearly, I think in Japan, just kind of the broad suspicion, I think, is that there's clearly opportunities on the margin there. Given Japan's been kind of in a malaise for a long, long time. But I have to confess that I don't have more detail than that. I don't think, honestly, it has any material impact on what we're doing, right? Because many of the managers in your program in the international markets, for example, are undertaking similar analyses and trying to position, accordingly. So I think, we're in pretty good working order there. That probably wasn't a great answer for you, but I don't have a.
That's okay. I don't know. I didn't fully understand the movie either. I was just wondering if you did.
He tries to go places where others don't, right? He finds opportunity or thinks there's opportunity, and certainly proven successfully that going to those areas that people don't like has often proven to be a winning hand if you've got a little discipline and time. So the only quick consideration for the committee, again, I guess this would be akin to the IPS in terms of ultimate approval, but within fixed income, we've talked in the past about Templeton Global Bond. I know Tyler talked about them in a DC setting, eliminating them. And one of the motivations there is described, it is a little bit different in an asset allocation perspective. But one of the motivations there is that Templeton, as you know, is a very high conviction, differentiated manager that is somewhat benchmark agnostic, right? So we have to run them to some type of benchmark, and we use the Global Government Bond Index to do that. Many times along the way, the construct of their portfolio looks very little like that index. And that's by design, right? And it's one of the things we've talked about is that if we're going to pay for active management, we want high conviction managers who have an opportunity over time to earn their keep. Templeton's been in the program for a long time, as you know. They have been running global bonds for 20 some odd years in this style. I think everyone who uses them and invests with them has a pretty good understanding now that they will dislocate from the benchmark and do so in pretty meaningful ways. because again, they're trying to generate these differentiated return streams. And in an allocation setting, like we've got with the pension plans, we do think there is still a role for that type of a strategy. And Templeton in that space is experienced as anyone doing it. And with the benefit of long periods of time, despite some of the more recent struggles, has actually done it pretty effectively. The contemplated action for the committee to think about recognizing the magnitude of tracking error that they can generate, and bear with me here if you can see it, is, we have had a school of thought with our research folks of perhaps dialing down a little bit the size of the exposure in Templeton in our investment programs. So you see here in the upper right-hand corner of the exhibit, what we're kind of contemplating in the case of the Simsbury, the 3 pension plans that use it currently, is maybe cutting the exposure in half to target. Does everyone see that in the upper right-hand corner? We've highlighted it. So the aggregate allocation to fixed income does not change. We just move a bit from Templeton and redirect that to your two anchor managers, MetWest and Western, and reproportion the 4 existing managers a bit. So that is in deference, again, right, to the magnitude of tracking error that the Templeton can generate alongside an investment thesis that we still think is valid, and an experienced team that we think in that space over time does a good job. But maybe we do it in with a little bit less octane back to the portfolio level.
So Chris, what's the recommendation?
So I think if you look, Kevin, in the exhibit, if you can make it out, they currently have a 5% target weight. You see,
right,
running a little bit different by plan, just by virtue of cash flows and that thing. But the recommendation here would be to cut their position in half, essentially, at the target level, as you can see there, and reproportion the 250 basis points to your 2 anchor managers equally.
Right.
They're each at 10%, right? We'd take them, I think, 11.25 in each case to target. And from a practical standpoint, we'd work with Amy and we'd just do the eliminations you see across the plans. We basically cut half the dollar amounts today and reproportion them accordingly into those 2 anchor managers. So,
and what's the recommendation based off of? I'm sorry.
So I think it's based on this idea that Templeton runs with a very high conviction, benchmark agnostic approach that kind of has high tracking error, right? It can have a lot of volatility. It can look very different than their benchmark. And that can frankly cause some angst, right? It can cause angst for us and it can cause angst for committees. We still like the team. We've just been kind of doing some research under the hood and think they need to be resized down a little bit in deference to that volatility.
So are they underperforming? Is that one of the
well, it's something to be aware of, but they underperform in the past too. So it's not a strict response to recent underperformance. We're certainly aware of that. I think it's just more broadly to the idea that they're so differentiated from the benchmark and can look so wildly different that we want to dial down that volatility within the fixed income arena just on the margin. And
what would be another fund that would be similar to the Templeton Global?
Yeah, bond? the other fund that in the global space that we use most commonly is a Brandywine fund, Brandywine Global Bond Fund. And some clients use that. We have a lot of clients that use Templeton. It's kind of about a mix and match. One of the things I'd say, Kevin, in your program and why we've used Templeton, honestly, is because if you look at the configuration we have elsewhere within fixed income, Western and BlackRock in particular, they run with kind of non-government profiles and commitments that tend to run heavier than their peers. Templeton tends to be more strict on global bonds as the basis for how they do things. So it kind of is a nice complement between the two. Some of our clients that have marginally more conservative fixed income mixes elsewhere from global bonds would use Brandywine because they use more non-government bond in their program, if that makes sense, right? So there's an appetite and an ability to accept that incremental risk alongside more conservative core managers. In the case of the Simsbury plans, MetWest, not so much, but Western and BlackRock will run more persistent spread profiles. And that's why Templeton's used here, because they don't do as much. So it's, if it makes sense, somewhat of a more complementary mix when you swedge everything together.
So who would be Templeton's peers then?
Yeah, Brandywine would be the most obvious one that we use in the space.
And is that the only one? Brandywine is the only.
There are others. There's a Loomis sales strategy that we've used a little bit. PIMCO has a strategy that we've used a little bit, but our two anchor managers in the global space have been Templeton and Brandywine. And again, the selection on those really is a byproduct of what you're doing elsewhere in your investment fixed income program.
So the recommendation is to cut in half the Templeton global bond by half based off of performance, or based off of?
No, based off, a recognition of the recent performance, but more based off, as I mentioned earlier, the idea that they do run a higher tracking error.
So a reduction in risk
strategy.
So
a little bit of a reduction in tracking error and risk in the program, and kind of redeploying back to the anchor managers. That's all.
Okay. Tracking error, could you just explain what tracking error means?
So tracking error, right? If you look at what a manager's return stream over time, right, based on how they're investing and the level of conviction and concentration that they have, it's the differentiated return from the benchmark itself. And in the case of Templeton, as you may remember, we've looked at it in the past, they have many outlandishly strong years where they're way ahead of their benchmark. And they will occasionally have years where they're materially behind the benchmark, right? Again, so the tracking errors statistically, or the differentiated returns from the opportunity set in the benchmark, can be higher than maybe other managers. And we're comfortable with that, understanding how the team invests, but we do want to be sensitive just in terms of holistically monitoring and overseeing and managing a larger pension program. Of that.
So it wouldn't be necessarily a performance-based decision, then it would be a risk-based decision.
It's a risk-based portfolio construct decision more than it is a response to performance.
Okay.
Just following up on Kevin's points, I don't quite get the theory of the case. You got to, most of it is fairly solid and steady as you go. Templeton is a bit more volatile, but it has not affected performance. So I don't seize the reason for doing this. It seems like Templeton does add diversity. It has a different approach, and it has not affected performance. And so could you explain to me why we want to do this?
Yeah, so I guess, Art, it's a fair perspective, right? And I guess it is very simply, we just want to be kind of aware of and sensitive where risks are in the program. And I think that, again, you've seen it recently in performance. If you looked through at the Templeton level, at the mandate level, that they have shortfalled the benchmark pretty materially over the last year and a half or so. And it's just a recognition in working with our research team and our fixed income analysts that they are running to target, right, a little bit more than 10% of dedicated fixed income, right? They're 5 part of 32.5. And right sizing them, giving them an opportunity with their approach to add some value over time, but not degenerating the larger results of fixed income over time, that we think a somewhat smaller position from them is more appropriate on a go-forward basis. And that kind of pairs with just our view of the world, where interest rates are globally, where valuations are for fixed income, what their opportunity is on a go-forward basis, and just a conclusion from a research perspective that a slightly smaller position from them within fixed income is more appropriate. That's all.
Yep. And one follow-up question from what Art was saying. I guess I'm not understanding the risk. Can you talk about the underlying investments? Are these what grades?
They're predominantly government bonds, Lisa. So by prospectus, 80% of their portfolio needs to be in global government bonds. But they also can add in exposures to select currencies as they see fit, right? So they may have a view on the US dollar, they may have a view on the Japanese yen or on the Swiss franc, and they express those opinions as well. So it's a it's a very differentiated approach is the only way to put it, right?
So I guess I would ask, if it's
80%
government, why is it so volatile?
Yeah, because they will own no government bonds in certain parts of the market that are in the benchmark, right? So they will very decidedly say, we may not like Japanese government bonds that are a big part of the benchmark and not have any or little to no exposure there, right? So while they're operating in that pond of government bonds, they will look very different than that benchmark if they don't like something. Again, maybe this is food for thought. I want to be deferential to time. I know we're coming into Kevin's hard stop, so maybe it's something we give the committee a bit of time to think about and we can revisit. But we did want to just put it out in front of you that we have been working to trim that position a little bit.
Chris, I don't have a problem bringing it up to the Board of Finance. If you could just write up some type of synopsis to where we can present it to the board.
Sure, absolutely.
And if you could just add an index bond fund that might be in an equivalent as opposed to management.
Yeah, well, let me look, Lisa. There's not a lot in the global bond space in terms of index. Let me look, though, with our research folks. We tend to default to active management there because of some of the inefficiencies globally, but I'll look.
It would be good to benchmark if there is one.
Yeah, that WIGB bond index that you see in the reports is what they use, but again, it's loosely tethered, right? Because they look so different than it. That's Mr. Chairman. I think we're on 8:45, so I wanted to be separate.
Yep. No, I appreciate it very much. Let's see. I guess we would be looking for a motion. So a couple of the things is we just have to make sure that Amy and Maria, that we have the things that we need to bring forward to the Board of Finance on the agenda. As far as the agenda, I'm not sure if there's anything else. So I guess I would be looking for a motion.
Make a motion to adjourn the meeting.
Do I hear a second? I'll second.
Chris Peterson seconds.
Thank you, Chris. Everybody, thanks a lot. We appreciate all the time that you devote to both the town and to the residents.
Okay, thank you.
Very good.
Folks, have a good morning.
Thank you.